What's going on, everybody? Welcome to SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage team. I appreciate you joining me today, and I'm excited to be here with you because we've got a ton of information to cover. I want to go over oh man, why is my information got to disappear on me? All right, there we go. I want to go over the happenings in the real estate and economic markets. Basically, if we don't fix the ceiling, then we might just end up on the floor. And so we're going to talk about the debt ceiling a little bit today. We're going to talk about the real estate market and the direction that that's going. We're also going to touch on inflation today, all the big bad boogeymen that are going on in our economy and our real estate market. So thank you for joining me for the ride. Let's dive in with the week in review. Last week, we got a lot of economic data. Starting out, we got housing starts and we got building permits. And these are important pieces of data because this tells us the direction of construction. And that's really important for our housing industry because right now, one of the main components of being able to improve inventory is going to be new construction. As a loan officer, as a lender, not my favorite topic because builders love to throw those all the money at clients to try and get them to use their lenders. But at the end of the day, we need builders building more homes to create inventory. And so it's a critical component of our real estate market. So housing starts, which measures single family construction starts. This is on an annualized basis. So we came in at 1.401 million. This was right in line with analyst expectations of 1.4 million. Now, with that being said, just to give you an idea or a comparison, we typically need anywhere from 1.6 to 1.8 million homes constructed on an annual basis. So this 1.4 million annualized pace is below where we need to be able to accommodate the number of household formations and the growth that we're seeing. Now, this was an increase from the previous or last month's reading of 1.37 million, but we're still well below where we need to be. Building permits, a little bit different, measures construction. This isn't specific to single family housing. This is building permits issued for construction projects. So this came in an annualized pace at 1.41 million, a little bit below expectations of 1.43 and below the previous reading of 1.43 million as well. Ultimately, building permits and housing starts coming in below where we need them to be or below the pace that we need them to be shows that we're going to continue to see shortages in the housing market going forward. We also got jobless claims last Thursday, as we always do every Thursday. And this is unemployment claims broken into two categories. We get initial claims, which is individuals filing for unemployment for the first time. And then we also get continuing claims, which is individuals renewing their unemployment benefits. So jobless claims on the initial basis came in at 242,000 jobless claims or unemployment claims. This was down from the previous reading of 264,000 and below expectations of 254,000. This has been very much a volatile number that's been vacillating up and down. And this ultimately tells us the health and direction of the labor market. Remember, new unemployment claims don't really happen until companies have gone through the cycle of hiring, growth, hiring freezes, reducing hours, then finally laying off workers. And that's what shows up in our initial claims. As far as continuing claims, we came in at a 1.799 million continuing claims. This was below expectations of 1.818 million, and it was a little bit below the previous reading, just north of 1.8 million as well. Most importantly, last week, we got existing home sales. Now, existing home sales or sales of non-new construction make up 90% of our real estate housing market. So this is a big, big number. And this shrunk month over month by 3.4%, came in at 4.28 million annualized pace. This was a tad below the expectation of 4.3 million, and it was well below the previous month's reading of 1.43 million. So let's stop and take stock of this information real quick. So if existing home sales makes up 90% of our real estate market, so that means that this number tells us how healthy our real estate market is to a large degree. Ultimately, we can't sell what we don't have. And you've heard me talk week after week about reductions in inventory and staying on a very low level. And so housing inventory is constraining sales. We're seeing less homes hit the market. We've only got about 1 million nationally homes on the market and at any given month. And we're seeing that constrain the pace of sales. Now, there's a lot of items that are influencing that. The interest rates are absolutely influencing it. The home price appreciation over the last several years and reducing affordability for home buyers is influencing that. And the fact that a large percentage of home buyers are not putting inventory onto the market. And you've heard me talk about this before, but what I mean by that is about 27% of home buyers are first-time home buyers who don't have a home to sell. They're not adding inventory. And another 18% of home buyers are investors. Typically, they're adding to their portfolio. They're not subtracting. So they're not typically adding any inventory as well. If you couple that with the fact that many more home buyers are starting to hold on to their existing homes at those low interest rates, and they're simply renting it out and purchasing a new primary residence, you have those buyers who are not adding any inventory to the market as well. So where is this inventory going to come from? And the answer is new builds. New construction is where we're going to have to see a significant increase in inventory in order to supply our real estate market with what we need to be able to have success and have a sound, healthy level of inventory going forward. So existing home sales, again, down 3.4% month over month, came in at 4.28 million annualized pace. Now, let's get to this week. This week, we got new home sales. And so this is closed sales on new construction. As I mentioned, since existing home sales is about 90% of our real estate market, new home is about 10%. So sales came in at 683,000 annualized pace. This was up a decent amount from the expectations of 665,000 and up even a little bit further from last month's reading of 656,000. Now, this all sounds great. We definitely are moving in the right direction. The question is, are we moving in the right direction fast enough? Are we seeing new construction at the speed that we need it? And ultimately, the answer is no. Right now, let's look ahead to the rest of this week. We've got some pretty big information coming out. On tomorrow, on Wednesday, we get the Fed's meeting minutes from their last meeting. Now, this isn't necessarily going to be market moving, but it is going to give us more insight into what the Fed is thinking and what we could expect from the Fed in the next Fed meeting on June 14th. Then on Thursday, as always, we get initial and continuing jobless claims. We also get the second reading of Q1 GDP. So we're going to get a glimpse into what our economy is doing, whether it's growing or contracting. And then we also get pending home sales, which measures signed contracts on existing homes. And then Friday's a big day. We get PCE, which is personal consumption expenditure. This is the Fed's favorite measure of inflation, and they track their goal towards core inflation on PCE being down at 2%. So this is going to be a pretty big number to determine what the Fed might be thinking going into their next meeting. Now, what are we focused on going forward? Well, the major focus right now, as you've heard all over the media, in the news, everywhere you look, it's the debt ceiling negotiations. And ultimately, I'll say this. The debt ceiling negotiations basically are a position where the United States is at risk of not being able to pay our debts as a country. If we were to default, this would be the first default in the history of the United States. And a default would have significant ramifications across our economy. There would be significant job loss, especially at the government level. There would be ramifications in the mortgage rate markets. We would likely see mortgage rates go up. We would just see lots of bad things happen in the economy. Now, with that being said, the media is painting a bloody, bloody mess if we were to default. And although there's absolutely going to be pretty significant negative ramifications. The media is definitely overblowing it, as they tend to do. They like to catch those eyeballs and get those viewers, so they're going to blow that out of proportion. Now, if we have a solution to the debt ceiling, we're likely going to see the markets rebound on that news. So mainly the stock market, we're going to see pressure taken off of mortgage rates. So the debt ceiling negotiations are critically important. Now, my personal opinion, I read an article, and I apologize, I can't cite it at the moment. Read an article that in the history of the US, we've been faced with a debt ceiling crisis 72 times. And the United States has not defaulted on our debts. We have not gone past our deadline on the debt ceiling negotiations. And so, although past performance is not indicative of future returns, my personal opinion is that it's highly unlikely that the government is going to let us default on our debts. Now, the negotiations may come down to the 11th hour, as they tend to with our government, but I do think that we're going to see a solution to the debt ceiling, and that's ultimately going to be a positive for the country. We just may have to go through a little bit of mud over the next week and a half to get to that point. Now, second thing that we're focused on going forward is, as it has been, inflation. We've got another Fed meeting coming up on June 14th, and we've got two inflation reports between now and then. We've got personal consumption expenditure, or PCE, coming out this Friday, and then we also get CPI, which is Consumer Price Index. We get that on June 13th, the day before the Fed convenes or finishes up with its meeting. Those two pieces of information are going to dictate what the Fed decides to do on its June 13th, 14th meeting. Right now, the consensus is we may see another Fed funds rate hike. Personally, ill-advised in my opinion. I think the Fed needs to give the economy time to absorb and digest the last rate hikes that were done. But there is some contention that we're going to see another Fed funds rate hike by another 0.25% next month. So we're going to keep an eye on that. The other piece of inflation news is how housing figures in. So core PCE, core inflation, 42% of that number is based on housing costs. And we've seen the cost of rents, as far as increasing costs, drop dramatically. We saw rents increasing at a pace of as much as 12%, 13% year over year, as recently as the last 3 to 6 months. That has dropped all the way down into the mid threes, 3.6% range. However, there's a lag when calculating the inflation numbers. So over the next 2 to 4 months, we're going to see that updated housing data filter into the inflation reports, and that will likely bring inflation down. Now, what's the good news about inflation coming down, other than it stops hitting our wallets and our pocketbooks so hard? Well, when inflation comes down, mortgage rates come down. And we're going to see that happen over the next several months. And that's going to help bring buyers off of the sidelines. So if you're a real estate agent watching this, just know that here over the next few months, have conversations with your clients with everything that I'm talking about. Feel free to send them to me if you don't feel comfortable having that conversation, but have conversations with your clients about what we expect in the next couple of months, how that's going to impact interest rates, and get them prepared. They may be on the fence now, but when those rates come down, you want to make sure that you're the trusted advisor that they turn to when that happens. And if you're a home buyer or seller right now and you're debating whether it's the right time to buy, I would tell you that right now, although we're starting to see multiple offers, we're still not in a hyper competitive market. There's still opportunities to get into homes without having to bid significantly over. I don't know that that's going to last for significantly much longer of a time frame. As rates come down, more buyers who are thinking just like you are going to come off the sidelines. That's going to drive demand through the roof. And as you heard me mention earlier, supply is not going to get a whole lot better. And that's going to create a hyper competitive environment, and it's going to cause home prices to rise at a pretty significant clip again. So great if you bought or if you own a home, prices are going up. But if you're waiting to buy, you may want to take a look at the market and decide whether that makes sense to spend more money in a home just to wait for a little bit of savings on the interest rate. So that, boys and girls, is everything that I've got for you today. We've had a rough week and a half in the mortgage rate market. Actually, I lied. I'm going to show you one more thing before I get going. Let me pull this up. Here we go. This is all you need to know is this is a chart of mortgage-backed securities. When these charts go down, mortgage rates go up. When the chart goes up, mortgage rates goes down. So as you can see, for the past week and a half or so, we've had a decline in mortgage-backed security prices. Interest rates have trickled back up. You've probably seen some articles saying rates are back above 7%, and in many cases they are, depending on amount of discount points purchased and things like that. We are in a re-elevated mortgage rate environment, but we are still trending down big picture. Rates are heading down over the course of the year. We're just not going to see that happen in a straight line. You can see here, up, down, up, down, up, down. We're just in a period of those bond prices coming down, so which means rates are up. So stay patient. Know that it's a temporary thing. Once we see that debt ceiling resolution, that's going to have some positive impacts across the economy. And as we continue to see inflation come down, that's going to help mortgage rates as well. If you have any more questions, make sure that you leave those in the comments below, or you can reach out to me at the number here. Thank you so much for joining me. If you are watching in the private Facebook group, Powerhouse Real Estate, make sure that you, I want to say thank you for being an incredible part of our community. If you're checking us out on our YouTube channel, make sure to hit that subscribe button so that way you can get up-to-date information about the economy, real estate, and mortgage at your fingertips. Thanks so much for joining me today. Have an incredible rest of your week. Take care.